Investors are currently facing a period of heavy hesitation. Economic growth is cooling while inflation remains sticky, creating an environment where a clear consensus on market direction has completely vanished. The catalyst for this shift was the June jobs report. The economy added only 57,000 jobs, a sharp drop indicating hiring momentum is stalling. To measure this, we use a macro score, weighting labor data against rate pressure and inflation. On a scale of 1 to 5, the environment sits at a 3, dead center, suggesting an economy slowing without a total break. This creates a specific complication. While hiring is slowing, inflation hasn't cooled enough for the Federal Reserve to immediately pivot to a more supportive stance. We aren't seeing a clear recession signal yet because unemployment hasn't spiked and wages are still growing, but the slowdown is undeniable. This puts the market at a yellow light. It forces a difficult dilemma on anyone holding broad market indexes, as a general buy everything strategy no longer aligns with the data. Wall Street is currently divided by a single question. Does this weak data mean rate relief, or is it a growth scare? In a rate relief scenario, weaker jobs reduce pressure on the Fed to keep rates high. This usually leads to lower yields and a cooler dollar, which gives stocks room to stabilize. But in a growth scare scenario, the market views those same weak job numbers as proof that a recession is imminent, triggering a flight to safety and a sell-off in riskier assets. We can see this tension in the price action. While semiconductors in the SMH have shown recent weakness, defensive areas like healthcare and financials have continued to trend steadily upward. Because the market is trapped between these two interpretations, investors have to choose which specific trade-offs they are willing to accept in their portfolios. One of the most popular responses to this volatility is to aggressively buy the dip in technology and AI-related stocks. This strategy is built on the observation that AI remains a primary driver of enterprise spending and long-term infrastructure growth. In practice, this means putting capital into damaged semiconductor ETFs like SMH or high-beta growth stocks that recently lost their primary support levels. This matrix shows the logic of the trade. If your input is a heavy allocation to semiconductors, the required outcome for success is that the Fed cuts rates immediately and the economy avoids a recession entirely. This approach relies on the rate relief theory being right. You need lower yields to support valuations. The trade-off is the risk of catching a falling knife. By buying sectors that have already lost technical support, you are betting against the current downward momentum. While the long-term story for AI hasn't changed, the current price action in semiconductors suggests they are in a repair phase. This makes them a wait-and-see trade rather than an automatic buy. On the other extreme, some investors are reacting to the 57,000 jobs number by making a total defensive retreat. This involves moving heavily into cash or pure utilities because of the fear that a significant market crash is now inevitable. This move provides the highest level of protection if a severe growth scare turns into a full recession. However, this chart illustrates the cost of that safety. Because inflation remains sticky, holding excess cash quietly erodes your purchasing power, while quality companies that can pass on costs tend to continue growing. A total move to cash is a bet on an economic break that the current 3 out of 5 macro data simply hasn't confirmed yet. A third option is selective rotation, a risk-adjusted compromise that accounts for both slowing growth and current interest rate levels. This strategy moves capital away from volatile, high-growth sectors and into areas like healthcare, financials, and consumer staples. The goal is to build portfolio ballast. These sectors are less sensitive to a cooling economy and provide stability when the broader market searches for direction. The trade-off is that you will likely underperform on days when mega-cap tech stocks have a sudden, high-momentum rally. In this environment, prioritizing companies with proven earnings and strong balance sheets is a way to stay invested while managing the risk of a growth scare. To apply this to your own portfolio, you can organize the market into 2 categories based on how the data is currently trending. If your focus is growth, the current evidence suggests you should stop averaging down on tech. Instead, wait for higher trading volume and clear price floors to appear before adding new risk. For those seeking a more balanced approach, the current trend favors increasing exposure to healthcare and high-quality blue chips that can maintain margins even as the economy cools. This framework highlights the divide. On the left is our leadership watch list, sectors like healthcare and financials that are currently trending higher. On the right is the repair watch list, including big cap growth and semiconductors, which need to stabilize before they are safe to buy. The objective isn't to predict when the tech sector will bottom out, but to align your capital with the rotation that is already visible in the market data. To know if this selective rotation is ending or accelerating, there is a specific checklist of macro indicators to watch. This dashboard tracks the 10-year yield, the US dollar, market volatility through the VIX, and semiconductor support levels. Currently, these indicators are in a neutral holding pattern. If the 10-year yield or the VIX spikes higher, the market is shifting into a growth scare. That is your signal to move toward a more defensive posture immediately. But if yields stay calm and the dollar begins to fade, the rate relief scenario is taking over. In that case, you can begin to slowly add back to market leaders that have confirmed price bottoms. The most important rule in this 3 out of 5 market is to wait for technical confirmation. When market leadership breaks, what looks cheap today can often become much cheaper tomorrow.